Welcome back, options traders. Happy Monday to everyone. And sorry for the somewhat of a long delay. And it's because I've got a very big event in Vegas around the 22nd of this month. So the videos, unfortunately, have had to take a back seat. But I'm going to try to get some out in the meantime, but I'll definitely get back on track once I return from the event. But here's a topic I thought would be a really good one to share with the group. And the reason I put this out is that I've been hearing a lot of traders talk about this lately. And they'll say when you buy an option, if we look at a time decay curve for an at the money option, you'll see that it decays fairly slowly at first and then it goes off a cliff. What traders sometimes call the dangerous part of the time decay curve or the cliff's edge. And they'll say when that happens, you need to either close your option or roll it because you don't want to be on the cliff's edge. And the thing that I want to show in this video is that while that sounds like a good idea, it's really hard to implement because it's really hard to say exactly where this cliff's edge is. So if that sounds like a tricky concept, it is. Let's go find out more. And before we do, as always, please be sure to click like and subscribe. It's greatly appreciated and helps to promote the channel. So before we get started, we have to review, and I know we've talked about this a bunch, but you can never review it too much. We have to talk about this square root pricing relationship. And what this is saying is that options just follow a square root pricing relationship. Again, that's for at the monies, not a linear one, even though that seems to be very intuitive. So for example, if we have a 1-month option trading for $1, this is what you're seeing in your broker's platform, what would the 4-month option be trading for? Well, an intuitive guess would be, well, there's 4 times as much time. It should therefore be 4 times as much, or $4. And unfortunately, that's not the way that it works. So we look over here. Yes, it is true that we have 4 times the amount of time, but that doesn't mean we multiply the 1-month options price by 4. We have to take the square root of this number. So that would be 2. So if you ever start using more complicated ones, just put the number into a calculator, hit the square root button, and it'll spit out the number. It's going to say the square root of 4 is 2. Now we have the answer. That tells us that the second option over here should be twice as much as the first one, not 4 times as much. So if this first option is trading for $1, the 4-month option, you would expect to be trading for 2. Now I say expect to. In a pricing model, yes, that would be exact. But if you're in a real-world platform, there can be skews. You might be looking at the midpoints, halfway points between the bid and the ask, and there are things that can throw that. The biggest one, though, is going to be a pricing skew. So they're probably not going to be exact, but again, in a pricing model, they would. But in the real world, they should be at least close. So if we saw instead as another example that this 1-month option we're trading for 3, the 4-month option should be trading for about 6. So this relationship is critically important to understand for seeing why it's hard to figure out where the steep part of the time decay curve is. So here is the time decay curve that these traders are talking about. Again, this is for an at the money option. That's the only time this shape applies. And so we have days to expiration here. We're starting out at 40 days. We're counting down to 0 at expiration. And given a certain volatility, I made it come out with the options price at 4. And I did this just to make the numbers easy. So the thing to notice is that this black line is relatively flat, or at least not as steep as it is down here, kind of flat through here, and then we begin to pick up steam. But somewhere in this area in here, that we would say, well, we're starting to go off this cliff. We're going to really start accelerating and losing value in our option, so we need to either close it or roll it. Well, let's back up here for a moment. When we had the option trading for 4, the theta is 0.05. That just means that it's going to lose 5 cents between today and tomorrow. So all things equal, we would expect this option to be trading for $3.95 tomorrow. But remember, options do not decay at this rate each and every day. That's just the rate at that moment. But there is an interesting relationship with the average rate of decay. So the average rate, we can say, is going from a starting point of 4 we end at 0 across 40 days. So $4 divided by 40 days is an average of 10 cents per day, or minus 10 cents. On your broker's platform, they'll put a minus there to show you that we are losing value at the rate of 10 cents. Now remember, your option is not going to follow this red line. That would be a constant or a linear decay rate. But if we can calculate the average decay rate, again being 10 cents, where is that going to occur on this black line? It turns out it's going to occur when 25% of this number remains. So we take a quarter of 40, and that's going to be when 10 days remains. So we have 25% of the time remaining, or 75% of the time has passed, and our theta will be exactly equal to the average theta. So if we have more than 25% of the time remaining on this side of the curve, we decay less than 10 cents per day. And if we have less than 25% of the time remaining, or in this example, less than 10 days, we decay at a rate faster than average. Now also notice this square root pricing relationship. When 25% of the time remains, we can work the process backwards. What's 25 squared is a half. And that will tell us that when 25% of the time remains, that our options price will be cut in half. And there it is. It will be trading for 2 instead of 4. And that's going to occur right on that point when 25% of the time remains. All right, so that's the backdrop. And this is where traders say, well, if you bought an option with 40 days to expiration, you're on a relatively safe part of the time decay curve because you're up here at the far left of the graph. But as time starts going by, once you hit, in this example, 10 days, or 25% of the time remaining, you're on the steep part of this time decay curve. You're going to start decaying faster than average. We've got to do something. We either have to close it or roll it out. Well, here's the problem with that. Are you really on the steep part of the time decay curve? Because notice what they're doing. When 10 days remains, you've got a 10-day option. Whether you like it or not, there's nothing you can do about it. It's a 10-day option. The option didn't know when you bought it or how much time it ever had. It's just a 10-day option. So if it's okay to look left and say, well, it used to be a 40-day option and the theta was half the amount at 5 cents instead of 10 cents, we're therefore on the dangerous part of the time decay curve. So the question I would ask these traders, again, does that mean that you're on a relatively safe spot when you bought it with 40 days? And they'd say, well, of course. You can see it right there in the graph. Well, okay, what if we look left again and we go out with 4 times as much time? Isn't that what you did here? You've got a 10-day option. You look left until you have 4 times as much time. So maybe this option had 160 days to expiration at some time. So here's what the time decay graph looks like with 160 days to expiration. The theta would be 2.5 cents per day. The average rate is 5 cents per day. And here is the 25% mark, right there, with a decay rate of 5 cents per day. Exactly what we just saw. So are you on the safe part of the time decay curve just because you bought it with 40 days? Because I can look left and say, oh no, you're on the steep part of the time decay curve. And if 160 days to expiration looks relatively safe compared to 40 days, I could go out with 4 times as much time and look at an option that had 640 days to expiration, and 160 would be right here. Now it's on the dangerous part of the time decay curve. See, it's what's called fractal. It's always in that same relative spot if you want to compare it to a time frame looking left. Well, then this is where traders come back and they say, well, you're just looking at it wrong. Time doesn't move left, it moves right. So when we have the 40-day option, we should be looking out this way and say that when we get to 10 days to expiration right here, this is the steep part of the time decay curve. And our theta at that point is 10 cents. All right, so what you're saying is that it's okay to look right and not left. Well, the option doesn't know when you bought it. If it's a 10-day option right now, Doesn't matter what it used to be, according to this logic. Doesn't matter that it used to be a 160-day option or a 640-day option. Right now, it's a 40-day option when you bought it. All right, if you want to stick to that argument, then when we get to 10 days, what type of option is it? Well, it's a 10-day option. And so should we look forward? Because that's what these people are arguing. You should only look to the right. Well, then are you on the steep part of the time decay curve with 10 days to expiration? Because I could still say, no, you're on the high part with 10 days to expiration. The steep part is at the 25% mark when 2.5 days remains. So your theta up here at minus 0.10 is now relatively safe, and down here it's minus 0.20. See, we can keep drilling down. You can always look right to a point that is 25% of this level. So let's line these curves up. Here's an option with 640 days to expiration, and you can see that 160 days to expiration is on the, let's call it the dangerous part of this time decay curve. Right there, where we're starting to go off that slope. But if we have a 160-day option, or maybe you bought it with 160 days to expiration, traders say, oh no, we're on the safe part. Well, wait a minute, over here you were on the dangerous part. Well, yeah, but I just bought it today, so it's a 160-day option. That's my starting point, so therefore the dangerous part is here at 40 days. Well, all right, but when it's a 40-day option down here, why isn't 10 days the dangerous part? And when it becomes a 10-day option, why isn't it 2.5 days? Look at that. You're in exactly the same spot. It just depends on if you want to compare it to a time frame moving left or a time frame moving right. So you can see the square root pricing rule right here. We started with an option worth 16. We knock it down to a fourth of the time. It's worth 8, gets cut in half. Knock it down to a fourth of that time, it gets cut down to 4. We knock it down to a fourth of that time, it gets cut down to 2. So all of these points stay in that same relative spot. So the biggest argument that I have with this is that traders just assume because let's say that you buy it today with 160 days, that somehow this means that you're at the safe part of the time decay curve, and that looking forward that 40 days is dangerous. But now you can see the problem with it. When we get down to this date with 40 days to expiration, I could say for somebody who just bought it today, they're on the safe part. And it's the 10-day mark that you have to be careful of. And then these traders say, well, yeah, but I bought it with 160 days, not with 40 days. That doesn't matter. You're holding a 40-day to expiration option. It doesn't know how many days it had when you bought it. So what's the point of all of this? Well, the point is that it's just a bad argument to say that the day that you buy it is somehow magically the safe spot of the time decay curve, and when 25% of the time remains, that becomes the dangerous part. But remember, it all falls back on this fallacy that the option doesn't know how many days it used to have or how many days it had to expiration when you bought it. If it has 40 days to expiration, it's just as if you bought it right now with 40 days, and we could now easily make the argument that the time decay slope, this cliff, happens at 10 days. So you have to remember that everything is a trade-off. And the biggest trade-off, or at least one of them that you're doing here by making the statement that you need to roll this option or close it, is gamma. So let's look at the gamma curve. So here we see with 40 days until expiration, I have a gamma of 0.04. But if I go out to 4 times that long, to 160 days, look at that, my gamma gets cut in half. Gamma is just as powerful of a concept or a factor for an option as theta. It just depends on what you're trying to do. So what if you were better off with a gamma of 4 than a gamma of 2? Well, now the 40-day option looks a whole lot better than the 160-day option. So just remember, the biggest point to take from this is that options trading is always about trade-offs. Every action creates trade-offs. And by action, I mean that you could roll it, you could morph it, you could hedge it, you can do some type of an overlay with it. It's going to create trade-offs. So just be careful of this whole idea when people say that you need to roll an option because you're now on the steep part of the time decay curve. Rolling to reduce time decay is expressing an opinion that low theta is better than high gamma, and that may not be true. So let's just jump over quickly to an option pricing model and see if these numbers line up. Okay, so now we're into the barchart.com pricing model, and I've got the underlying stock at 100, strike at 100. Remember, this relationship only applies to at-the-money options. We're going to give it 40 days to expiration. I'm going to leave interest rates out because that can throw the calculations a little bit for the cost of carry. Volatility at 30.3% and no dividends, and we see that the options price is worth 4. So notice that my theta is 0.04996. That's 0.05. So what would happen if I increase this by a factor of 4 to 160 days? Well, my theta is going to drop from 0.05 to 0.025. It's going to get cut in half. We're going out 4 times as much time, so this number gets cut in half. What will happen to my gamma? My gamma is also going to get cut in half. It's going to go from 0.04 to 0.02. All right, so watch this. Let's go to 160 days, and there we go. Theta's at 0.025, but see, your gamma also got chopped to 0.02. So if you want to make the argument that you're now on the steep part of the time decay curve because you used to have 640 days to expiration on this option, whether you owned it or not, it doesn't matter. You bought it with 160 days. So now going in the other direction, let's go back to 40. So we've got our theta at 0.05, but see, now our gamma is starting to peak. We got 0.04, depends on what we're trying to do. But if you buy an option with 40 days and it now has 10 days, 25% of the time remaining, yes, no argument, your theta is going to double to 0.10. But your gamma is going to go to 0.08. So let's do that. Let's go to 10. And there we go. There's our 0.079. That's basically 0.08. And there's your theta at minus 0.10. See, now are we on the steep part of the time decay curve? It depends on where you want to look. I could knock this down to 2.5 days, in which case this is going to go to 0.16. We're going to get lots of gamma here, and this is going to go to 0.20. So let's go to 2.5 days. There's our theta of 0.20. Gamma is now 0.16. So again, the point is that it's all relative. For any expiration or any option that you're currently holding, you could make an argument that it is absolutely on the steep part of the time decay curve, depending on when you want to start time. So the main thing is always focus on your goals. What are you trying to accomplish? Sometimes gamma is going to be the hero, sometimes it's going to be theta. But you need to understand what it is you're trying to do. And instead of following this really bad advice that you have to roll an option or close it just because you're on the steep part of the time decay curve. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a Candlesticks and Technical Analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.